We're going to be discussing index funds. This section is going to focus on your long-term goals. These are goals that take you 10 or more years to achieve. Remember, our goal is to empower you to be a DIY investor, not a financial trader making frequent trades, buying and selling often. In fact, our goal is the opposite, a steady diet of buying investments and only rarely selling in order to balance your portfolio or to fund one of your goals. The less your assets are touched, the less chance for fees, taxes, or for you to spend it on something not aligned with your long-term goal, which means there's a greater opportunity for your assets to grow. For this presentation, we will be referring to the broad category of index funds. The term index funds has evolved over time to refer both mutual funds and ETFs that employ the same strategy of providing passively managed, low-cost products that replicate an identified benchmark, such as the S&P 500. Let's dig in. As we discussed, we'll be talking about long-term goals. For long-term goals, the longer your time horizon, the greater the impact of fees, lack of diversification, and portfolio allocation. Index funds are an easy way to address all of these three things. Since long-term goals are higher stakes, we will take some extra time on this strategy to achieve them. There are many different types of investment products that you can buy. Here is an overview of some of the main types. We do not recommend that a beginner investor buy all of these. This is mainly for informational purposes. We're going to focus on target date funds and index funds, as they are the easiest to implement and have the best options for the DIY investor. We are usually very fee averse, but sometimes a fee can buy you other assets, like time or less stress. Know thyself. If you want a less hands-on approach, a target date fund can be a good fit. For a target date fund, the portfolio allocation is done automatically. The target date of the fund is the date that you will need to access the fund. For example, if you are retiring in 40 years, the target date from today will be 2063. They're usually very reasonable cost options. Choose one that uses an index or are automated to reduce costs. And with these target date funds, the goal is to set it and forget it. And you will only adjust if your timeline or goals change. Not all target date funds are the same. Look at the fees, comparison shop if you can. Most of these are commonly found in your 401k and 529 plan. Next, we'll be discussing the index fund. Index funds are a type of mutual fund or a type of ETF. They are passively managed, which means they do not need to be constantly monitored. There are index mutual funds. You invest in a pool of money, and that money is used to purchase a piece of each company according to the index you select. For example, an S&P 500 index fund owns stock in the 500 companies listed in the S&P 500 index. The indices used in these mutual funds and ETFs change. People choose them, and the computer adjusts based on them. There is variety within this category. Like with target date funds, make sure to comparison shop. There's also index fund traded ETFs. An index ETF will use the index to determine the comparison of its fund. For example, total NASDAQ index ETF will own stock in all companies represented on the NASDAQ. We like to look to Warren Buffett's simple advice for his estate as described in his 2013 annual letter. My advice to the trustee couldn't be more simple. Put 10% of cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. So why index funds? The main reason is because of diversification, and they are passively managed. So for diversification, this minimizes your risk because you own a variety of companies or bonds. You minimize unsystematic risk, aka company-dependent risk, and they are passively managed, which means there's a much lower cost fee, and fees are described in the expense ratio. One way to look at that would be actively managed mutual funds. ETFs are typically 1% to 3% in fees, or they should be, and index funds are normally less than 1%. Some are even 0%. Actively managed mutual funds or ETFs must pay teams of fund managers and analysts to develop the product, which is the reason for those fees. So why index funds? Availability. Most high-quality accounts will offer common index funds. They facilitate rollovers and the ease of research. There's tax efficiency as well. Index ETFs hold capital gains inside them, giving them a tax advantage. Both less frequent trading means less tax events. Performance. Research has shown that passively managed investments like index funds and ETFs consistently outperform actively managed funds. Returns will mimic the returns of the selected index. When the S&P 500 goes up, your S&P 500 index fund will go up the same amount. Same happens when it goes down. To identify index funds, your brokerage account, retirement plan account may or may not offer the index funds in our examples. Ticker symbol versus name. Retirement plans often have better index fund options offered at a lower expense ratio. Here's an example. VFFSX, which is the Vanguard 500 Index Fund, Institutional Select, has an expense ratio of 0.01%. You want to make sure you read the name of the fund and its description. The name of the fund should include index fund if it's an index fund. The description of the fund should describe the index that the fund is tracking. The Vanguard 500 Index Fund tracks the Standard & Poor's 500 Index. Look at the expense ratio. It should be less than 1%. Here is a sample ticker symbol with its name. So as you can see, as for VTI, it's the Vanguard Total Stock Market Index Fund. And you would search up the index fund that you want by its ticker symbol. Here's an example of a sample portfolio. Remember, these are not investment recommendations. These are examples of investments used by a lot of people in portfolio construction. J.L. Collins is famous for a 100% equity approach to long-term investing in just one index fund. This is a very aggressive approach and very risky. Some index funds that you could use to build this portfolio are the VTCSAX, the VTI, and the VZROX. As you can see, their expense ratios are well below 1%. And this would be a great way to diversify your investments. There is another sample. This is a more traditional approach to portfolio construction. Some index funds that you could use to build a portfolio like this are 60% of VTI and 40% of VGIT. And as you can see, the expense ratio is less than 1% as well. And this portfolio is organized in a 60-40 method, 60% in VTI and 40% in VGIT. Investors who admire John Bogle, the founder of Vanguard and the visionary behind the index funds, call themselves Boglehead. This portfolio is made up of the following: 60% stocks, 20% international stocks, and 20% bonds. And here is an example of how you could break that down. You can do VTI at 60% in US stocks, VXUS 20% in international stocks, and VGIT in intermediate bonds. For our last slide, we want to discuss fee awareness. 3 things that impact your portfolio performance are investment performance, taxes, and fees. Often we focus on the first without considering the equally huge impact of taxes and fees. Let's discuss fees. We advocate for fee awareness. Do you know the fees that you are paying? Are the fees you're paying providing you the expected value? Less stress, more time, higher performance? While we think of fees as negative, there can be benefits to them, but it just is important to be an informed consumer and make sure you are aware of all the fees. Remember in this graphic from the beginning, there are many layers to fees. At each level of this graphic are different fees. Here are some of the fees you may incur. For a brokerage house, you'll have fees for processing transactions, fees for providing services. There will be account fees, fees for having an account, fees to open and close an account. For mutual funds, there will be an expense ratio, which is a fee. For mutual funds, we may have other fees such as front end, back end, 12B1 fees. Fees are part of the game, and they are just something you need to be aware of. Remember this chart from earlier? We used it to show how long it would take to double your money with the power of compounding. Now look at this chart through the lens of fees. Imagine your investments are growing at 6%. However, you have a 2% fee. It will take you 6 years longer to double your investment due to the fees. Not sure how to find your fees or if the fees are providing the value you want? Schedule financial coaching one-on-one, and we can help you understand the fees that you are paying. So for next steps, we're going to research index funds available to you in one of your accounts, identify an index fund that aligns with your goals, execute a buy order, and voila,